Many financial advisors tell clients age 50 or older to split their portfolios between stocks and bonds, usually 60% bonds and 40% stocks. But are bonds really a good investment for anyone? And just what exactly is a bond? In essence, a bond is a type of debt. When you buy bonds, you're temporarily loaning the bond purchase price to the bond issuer, which is one way they raise money. In exchange, the bond issuer, typically corporations, government agencies, and nonprofits, is essentially borrowing money at interest from you, their investor. Today, the total amount of debt outstanding exceeds $40 trillion. It includes over $14 trillion in U.S. Treasury debt, more than $9 trillion in mortgage-related bonds, nearly $9 trillion in corporate bonds, and almost $3.8 billion in municipal bonds. Bond yields are respectable but often modest. They're unlikely to make you rich. Currently, corporate bonds are paying yields in the range of 3% to 5%. Now, let's compare bonds with an alternative asset class: private lender note investing from our company, Max Returns. Our secured notes give you returns equal to and often better than bonds with good security. As with bonds, private lender notes are in essence an IOU. The note says that a borrower promises to repay the lender a certain amount of money in a given time frame. A big difference is that notes generate consistent annual returns, typically 6% to 10%. In sharp contrast, bonds can be extremely volatile, because when interest rates rise, bond prices plummet. Another major difference is that our private lender notes are backed by hard asset collateral. Bonds aren't. Each individual private lender note is tied to a specific property we own in our large portfolio of residential real estate. This hard collateral means that you will never lose even one thin dime as an investor in our private lender notes. That's because the collateral assets are worth more than the total value of the notes we issue. So if needed, we can simply sell some of our assets, ensuring that every investor is paid back in full, principal plus yield. No ifs, ands, or buts. That way, return of your principal is 100% guaranteed. Again, because the value of the hard assets backing up our notes is 25% greater than the price of the notes themselves. As for bonds, they're unsecured by any hard asset. As a result, their value can plummet. For instance, in 2014, a bankruptcy plan approved for Detroit left some investors holding bonds of questionable worth. In 2016, Puerto Rico defaulted on $58 million in debt. Then in 2017, Hurricane Maria devastated much of Puerto Rico and its economy. Result? The future of its bond payments is now uncertain, which may leave the bond owners holding the bag. If the US defaults, as has already happened several times in its history, Treasury bonds would become worthless. And today, federal debt outstanding is a staggering $22.5 trillion. Let's quickly review why private lender notes are a smarter alternative to bonds. Better rate of return with consistent cash flow. A private note with an 8% annual gain has nearly 3 times the 2.8% return mini bonds were yielding in 2020. Private lender notes are secured by tangible assets. Bonds are not. Private lender notes have a fixed value. Bond prices can suddenly drop based on the misfortunes and economic losses of the governments that issued them. Okay, so now you know the many advantages of private lender notes over investing in bonds. Additional video lessons from Max Returns compare private lender notes to other investment vehicles: stocks, mutual funds, T-bills, CDs, rental properties, so you can make the investment decisions that are right for you. The next step? Just click below to choose your next free lesson and watch the video now. You'll be glad you did.